Ugh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome, everyone. Today, we're going to dive deep into a really interesting and I think often overlooked business structure, the limited partnership. You'll hear me call it the LP. We're going to break down its strategic advantages and figure out exactly when it makes the most sense for a new business.
So here's how we'll tackle this. First, we need a solid framework for how to even think about choosing a business structure. Then we'll put the LLP in the ring, so to speak, against a standard partnership and a corporation. We'll see how they stack up when it comes to both losses and profits. And to wrap it all up, we'll look at some real-world examples to see where this all plays out. Okay, so when you're picking a business structure, what's the end goal? It's actually pretty simple. You want to minimize the cash you need from investors to get started, and you want to maximize the cash they eventually get back. It really boils down to optimizing that cash flow right from the very beginning. And to do that, you need a good system, a checklist, if you will. We have to look at any potential structure through these four key financial questions. 1. What's the yearly tax bill going to look like? 2. If there are losses at the start, how can we actually use them? 3. What's the absolute maximum an investor could lose after taxes? And 4, and this is a big one, how much does it cost in taxes just to get the profits out of the company and back to the people who invested? All right, let's jump into our first comparison. How is a limited partnership, an LP, different from a regular standard partnership? They sound similar, right? But believe me, the structural differences open up totally different possibilities. It really comes down to three huge differences. First up, liability. This is a biggie. In an LP, you have limited partners whose risk is capped. They can only lose what they put in. But in a standard partnership, nope. Everyone is on the hook for everything. Second, who's running the show? LPs are built for passive investors, people who put in money but don't manage the day-to-day. Standard partnerships assume everyone is more hands-on. And third, and this is a really important detail we'll revisit, how tax losses are handled is different for those passive partners. Now, you might be thinking, so what? Well, this has a massive impact on your ability to raise money. Think about it. With a standard partnership's unlimited risk, who's going to invest? Only people who are super involved or rich enough not to worry about losing their house. But the LP, by limiting the risk, it throws the doors wide open. Suddenly, you can attract a much bigger crowd of smaller, everyday investors. And for a new company, that can be a total game changer. Okay, so that's LP versus a standard partnership. But now for the main event, really, LP versus a corporation. And we're going to focus on those early years when a new business is often losing money. This right here is where the LP can be a superstar. Let's run through a quick example to see what I mean. Picture an investor. They're passive, not running the business, and they're putting $10,000 into a new venture. Now, the business plan is pretty clear. It expects to burn through $4,000 of that on startup losses. Here's the key. The business needs that full 10 grand no matter what. But what it actually costs the investor, well, that depends entirely on the structure. So if we set this up as a limited partnership, that $4,000 loss doesn't get stuck inside the business. It actually flows right through to the investor's personal tax return. Let's just say they're in a 50% tax bracket to keep the math easy. They can now use that $4,000 loss to reduce their other taxable income, which gives them an instant tax saving of $2,000. See that? It's immediate. And the effect of this is huge. Yes, the investor writes a check for $10,000 to the business. But because they get that $2,000 tax break right away, their actual out-of-pocket cost is only $8,000. The business structure itself just saved them $2 grand. It's like the tax code is helping to fund the venture. Now, what if it was a corporation? That same $4,000 loss, it's locked up inside the company. It does absolutely nothing for the investor's taxes in year one. So their cost is the full $10,000. Right there, you see the power of the LP. When you're trying to convince people to invest in a risky new project, being able to say your actual cost is 20% less, that's an incredibly powerful pitch. Okay, so the LP is great for startup losses, but what about when things go well? What happens when the business starts making money? Well, the choice of structure is just as important. But now we're looking at a different beast, the classic problem of double taxation. Let's just look at the numbers here. They speak for themselves. Say the investor's share of the profits is $400,000. In a corporation, first the corporation pays tax. Then, when the money is paid out as dividends, the investor pays tax again. You get hit twice. The total tax rate ends up being 53%, and the investor walks away with $190,000. Now look at the LP.
The business itself pays zero tax. The profit just flows through, and the investor pays tax once. The after-tax return? $200,000. More money in the investor's pocket. It's that simple. So, what's the bottom line here? Because the LP is what we call a pass-through entity, it completely avoids that double taxation trap you see with corporations. And this isn't just a minor accounting trick. Over the life of an investment, this can add up to a huge difference in what an investor actually takes home. But, and this is a really important but, it's not all sunshine and tax savings. There is a catch, and it has to do with that limited liability we talked about. With a corporation, that liability protection is pretty much automatic. It's baked into the structure. But with an LP, that protection is conditional. You have to follow specific rules, and if you mess up, that shield of limited liability can just disappear. And that is a very serious risk you have to factor in. So we've got the pros, we've got the cons. Where does this actually make sense in the real world? Let's walk through a few different scenarios, from the super risky all the way down to the pretty safe bets. Okay, first up, high-risk ventures. Think oil and gas exploration, mining, heavy R&D. These are businesses that eat up a ton of cash up front, have a good chance of failing, and generate huge losses in the beginning. For these, the LP is practically tailor-made. Why? Because it lets investors use those massive early losses to get an immediate tax break. It takes a huge bite out of their risk, which makes it infinitely easier for the people running the project to actually raise the money they need. All right, what about something in the middle? A medium-risk project, like a company that's rapidly expanding a chain of hotels. Maybe they can't get all the bank loans they want, each new hotel is going to lose money for a bit, and it's going to generate big tax deductions for depreciation. We call that capital cost allowance. Again, the LP is perfect here. It can take all those tax deductions that the business itself can't use and pass them straight to the investors. It's another way to make the deal sweeter for them. Now here's one that might surprise you. Even for low-risk ventures, businesses that can get bank loans easily and are probably profitable right away. You might think, why bother with an LP? Well, remember that double taxation problem. It doesn't go away. By using an LP, you can offer investors a better after-tax return. And what does that mean? It might mean you can raise the money you need by selling a smaller piece of your company. You get to keep more of the equity. Okay, let's pull all these threads together and sum up what makes the LP such a strategic tool. Really, when you get down to it, the LP is like a powerful hybrid. It tries to give you the best of both worlds. You get that critical limited liability protection for your investors, just like a corporation, but you also get the tax efficiency of a partnership, avoiding that double tax hit. It's this 1-2 punch of lower risk and better tax breaks that makes it such a fantastic way to raise money, especially for those businesses that know they're going to be in the red for the first couple of years. So this leaves us with one last big question to think about. We've just seen all these cases where the LP offers better tax outcomes for investors. So why is the corporation still king? Why is it the default for so many businesses? The answer, I think, is a trade-off. It's about weighing those incredible tax perks of the LP against things like the risk of losing that liability shield, and maybe just the simple fact that the corporate world is more familiar and feels more straightforward to many. It's something to chew on. Thanks for joining me for this analysis.